Welcome to Yahoo Finance's flagship show at The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, earnings are the key focus for investors this morning. U.S. stock futures are a little changed amid an onslaught of results that are moving individual stocks, including companies like Dow Components, 3M, and Coca-Cola. Coke shares rising on better than expected results, but the company warning that soft drink demand does remain soft. Other movers to watch this morning, General Motors surging after raising its guidance thanks to strong pickup truck sales and fresh relief on tariffs on auto parts. And the company to watch after the close is Netflix. The streaming giant is the first of the big tech names to report third quarter results. Analysts are watching momentum in the company's advertising business, and they expect results to be driven by strength in its content slate, from films like K-pop Demon Hunters to live sports events. And this morning, China speaking out after the U.S. struck a deal with Australia on rare earth minerals, saying the two countries should take a proactive role in stabilizing that supply chain around the world. Monday's announcement coming ahead of President Trump's highly anticipated meeting with Chinese President Xi Jinping next week. Let's get a check in on stock futures right now. We're seeing little change, sort of a mixed picture here. This is not unusual, right? When we start to get into the thick of earnings season, you get a lot of the individual stocks moving a lot, but it doesn't always translate into big themes and big moves for the major averages. We'll see how this continues to play out. So let's dig into our top stories of the day. Earnings season is indeed underway with General Motors, Coca-Cola, industrial names all reporting this morning. Joining me now, Yahoo Finance senior reporters Ali Canal and Brook DiPalma. Guys, I want to start with General Motors because it is a big move for GM. Last I checked, they were up something like 11%. Ali, let's start with you.
Stock is up well over 10% at this point in pre-market trading, Julie, and this comes despite a mixed earnings picture, but a big boost to full-year guidance, along with more optimistic rhetoric around the tariff picture. So earnings came in ahead of estimates, whereas revenue slightly missed. But if we take a look at the full-year guidance, GM now says it expects full-year earnings between $9.75 and $10.50 per share. That's up from its prior range, and also said that adjusted EBIT could top $13 billion. Now, EBIT, or earnings before interest and taxes, is a key measure of operating profitability. So it basically tells us how much GM is making from its core business. And this comes even as the company does continue to grapple with the weight of tariffs. The company now estimates that will register a hit of $3.5 to $4.5 billion this year. That's slightly better compared to what we saw in the spring. CEO Mary Barra striking a more optimistic tone when it comes to the future. She did thank the Trump administration for new tariff mitigation policies that will make companies like GM and other U.S. manufacturers more competitive. GM does expect those offsets to cover about 35% of tariff costs. And then if we zoom in on the quarter, I mentioned how earnings came in ahead of estimates. $2.80 per share for adjusted EPS. Revenue came in at $44.3 billion. Again, light of estimates. And then adjusted EBIT, that came in stronger than expected at $3.4 billion. So overall, a mixed earning picture, but that full year boost and more optimistic tone helping drive shares with those double-digit gains that we're seeing early this morning, Julie.
And Ali, what specific vehicles really drove this? I think pickups, right, were part of the picture?
Yeah, those gas-powered pickup trucks, those SUVs, those continue to drive a lot of the momentum that we saw in the quarter. U.S. sales rose 8% to more than 710,000 vehicles. This represented GM's best market share since 2017. EV sales also hit a record 66,000 units. Now, that comes ahead of the expiration of those federal tax credits. So GM did warn that from here, EV demand is going to slow substantially. The company did take a $1.6 billion charge linked to its EV reassessment, saying, quote, near-term EV adoption will be lower than planned. Still, over the long term, GM does remain optimistic about this business, and they basically describe the slowdown as an opportunity to better the product in the meantime. Here's a look at what GM CFO Paul Jacobson told our executive editor Brian Sazzi early this morning.
This slower demand is going to give us an opportunity to improve our battery chemistry and our form factors, realizing thousands of dollars per vehicle or savings, and ultimately be in a position to scale up as the consumer does.
So basically right sizing now to hopefully win later. Now, a big question is not just the function of these vehicles, but also the infrastructure. That has been an issue when it comes to how quickly consumers have wanted to adopt EV vehicles. So we'll see how that goes down the line. But for now, investors clearly cheering the report, up over 10% in early pre-market trading.
And let's talk about Coca-Cola as well. That company out with earnings this morning. And on the surface, they look pretty good, Brooke.
Yeah, they look pretty good, and this is another company that's reporting better than expected earnings at both the top and bottom line. When you take a look at the numbers, we did see a slight miss on revenue there, but adjusted earnings did come in better than expected, really powering that momentum behind what would be this very large expectations for this third quarter reports. And that's why you see the stock moving higher this morning. It popped about 2.7% in early innings of the pre-market trading session this morning. And if you take a look underneath the hood, there were a few key things that really stood out to me in this report. We've been talking about this bifurcation of consumers. Of course, Coca-Cola, a brand that really caters similar to PepsiCo with different segments to different consumers here. But we did see growth in Coca-Cola Zero Sugar, something that we've been talking about as consumers really seek out alternate options. Also, particularly here in North America, as well as other regions, we did see water and those sports drinks also stand out in the quarter. And beyond that, they reiterated their guidance. They're expecting organic revenue growth to end the year. They're also expected adjusted earnings to grow as well. But we did see North America volume flat. And that's really different than what we've seen in years past, particularly 2021 and 2022, when many consumers were at home and consuming Coca-Cola. That really drove volume growth up. To give some context, global unit volume grew about 1% this third quarter, but that's far less than the 4% growth that we saw in the third quarter of 2022. And there were some things that right now are being mentioned on the call that contributed to this. They said that some factors are transitory this quarter. They had unusual weather, but there's also some long-lasting factors like inflationary pressures, uncertain trade dynamics, and an ever-changing geopolitical environment. That's certainly impacting consumer demand right now, but they did say that affordability is a key feature, as well as innovation like that Coca-Cola Zero Sugar, which saw 14% growth this past quarter.
And guys, one of the other areas that I'm watching this morning on the earnings front has to do with aerospace and defense, or industrials, right? We got General Electric, GE Aerospace, that's the aerospace part of the businesses that split up, raising its full year outlook for the second quarter in a row. And the themes that we're seeing within aerospace are actually some of the same themes that we're seeing in some of the other companies that we're talking about, namely that these aerospace companies are seeing demand in commercial and in defense. And secondly, that we're seeing sort of a mitigated tariff impact that's being expressed by these companies, that as the year has gone on, the largest companies have sort of figured it out. And in the case of a company like GE, has actually reduced its estimates for tariff impact over time. So GE raising its forecast, as I mentioned, for the second time this year. Third quarter revenue up 26%, and it really saw demand on both sides of its business, on the commercial side of the business and on the aerospace and defense side of the business, the more government side of the business. RTX also raising its forecast for the second time in this year. And so that also benefiting those shares as well. And if you look at the four aerospace and defense contractors that reported this morning, you have GE, RTX, Lockheed Martin, and Northrop Grumman. GE and RTX are higher. Lockheed and Northrop were lower at the last check of those shares. But all of these stocks, with the exception of Lockheed, have done pretty well this year. GE is up more than 80% year to date. RTX is up 39% and is trading near a record high. So it has been a strong environment for these. So guys, it's just sort of the theme here that we continue to see many of these companies beat estimates because of a strong, the strong backdrop that we're seeing here. Allie, Brooke, thanks so much. And we should mention, by the way, stay tuned. We'll be bringing you the full interview with GM CFO Paul Jacobson in opening bid at 9:30. And we'll also be speaking with Coca-Cola President and CFO John Murphy in the 10 a.m. hour of Market Catalyst. There's also just a bit of breaking news that we wanted to bring you here and keep Allie on this while we have her because this is something on her beat, and it has to do with Warner Brothers Discovery, which is now formally starting its review of strategic alternatives. Now, Allie, as we know, this is something that has been reported on. We know Paramount was reportedly interested in an acquisition of at least part of Warner Brothers Discovery, but we also know WBD was talking about breaking itself up. So what exactly is this announcement today?
Yeah, so this is a press release that I'm just digging through right now, and Warner Brothers Discovery saying that it's reviewing strategic alternatives amid some of that new takeover interest that you were just alluding to here, Julie. Paramount reportedly interested in certain parts of the business, and this comes even as the company still plans to separate into two separate businesses come mid next year. The company is saying in this release that it has received unsolicited interest from multiple parties for the entire company as well as its Warner Brothers Studio division. Now, that's prompted the board to consider a wide range of options. This includes selling all or parts of the business or potentially changing the structure of its planned separation between Warner Brothers and Discovery Global. Again, currently slated to be completed by mid next year. CEO David Zaslav saying that this move reflects growing market recognition of the company's value and that the board is committed to finding the best path forward that will unlock full value for all shareholders. That's a line that David Zaslav has continuously used when it comes to finding the best plan for this business, whatever can unlock that value for shareholders. The company did stress that there's no set timeline and no guarantee that any deal will result. But essentially, bottom line here, Warner Brothers Discovery keeping its breakup plans on track, but is also open to offers. And you're seeing the shares react here this morning, up in pre-market trading on the heels of this. Perhaps this could attract some other interested parties in putting some bids.
And it's interesting when you look not just at today's reaction, which makes sense in light of everything you've been talking about. The stock this year is up more than 70%, but most of that gain, almost all of that gain, coming after these reports started surfacing, right? So clearly investors were not happy with the status quo. And so that's why they're greeting this news that indeed the company is continuing to try to figure out something to maximize value.
Yeah, and Warner Brothers Discovery has been struggling. Really, a lot of these networks that are exposed to linear television have been struggling. We've seen advertising on linear TV just take a nosedive. There's virtually no real revenue coming out of that side of the business. So we've seen that doubling down on a lot of these streaming initiatives, but that also is tricky, especially in an era where consumers are being a little bit more choosy about the platforms that they're choosing to sign up for. You have a lot of the big tech companies like Apple, for example, throwing a ton of money at sports content. We just had that breaking news last week that Apple has formally acquired those F1 media rights for $750 million. Apple has the balance sheet, the cash on hand to be able to do this. Same with Amazon, which we know has made its commitments to a lot of different sports endeavors. And Warner Brothers Discovery was recently pushed out of that deal with the NBA because they just simply didn't have the capital to fund it. So it's clear that there's a big change happening across the industry. There needs to be more mergers and acquisitions. Not every company is going to survive this period. So we're going to see a lot of this selling for parts type of strategy here across the industry. And Warner Brothers Discovery is definitely caught in the middle there. And you saw a similar story with Paramount when there was all those reported bids. The stock definitely oscillated and was very volatile. Then ultimately Skydance took over and won out. And now we have Paramount Skydance, and they're, seeming to be a big acquirer of a lot of these content machines and engines. So we'll see where the future heads for Warner Brothers Discovery and really all the other streaming platforms.
We will. Thanks a lot, Allie. Appreciate it. And we're still following the continuing story of an interruption to Amazon Web Services on Monday. It has been resolved, according to the company. Investors didn't seem too troubled by the outage, with Amazon ending the day higher. Speaking to Yahoo Finance, Dan Flax, Neuberger Berman senior research analyst, said he doesn't see this as an issue for Amazon.
The outage today doesn't change our view on the stock and the longer-term outlook for the company. Really, the key is, can a platform like AWS can recover, which I believe they will very quickly, continue to invest, drive value for their users, and really unleash a whole new wave of innovation in key areas like generative AI.
Dan Halley is here with me now, our tech editor. And Dan, there is what Wall Street thinks and there's what the public thinks. And it is pretty unusual when I get home and my kids say to me, we couldn't do work at school today because of the AWS outage, or my salad wasn't ready when I went to the salad place across the street.
Yeah, got to go back to handouts that you would get for homework. I mean, this is one of those things where, it just kind of shows the fragility of the modern internet and really everything that our society is kind of based on now, right? AWS, one of the largest cloud providers, the largest cloud provider, they had an issue with their domain name system. You can essentially, the usual way to think about this is a kind of phone book for the internet where you type in something in your browser, Amazon.com, for instance, or YahooFinance.com, and the domain name system basically translates it into the actual IP address that you're supposed to be routed to. So, think of it as the operators, in those old phone videos, kind of connecting the wires to the right place. And so that's essentially where the issue started. It kind of cascaded from there, and then they ran into other issues. And it knocked off, you could see before, a number of different businesses, whether that was related to Amazon's own services, McDonald's, Roblox, Zoom, Venmo. You didn't have to send rent maybe to your friend. So I know Slack had issues as well. If you were lucky enough, you got knocked offline and didn't have to work for the day. We were not so lucky. But it's one of those things where we do have Amazon, we do have Google, we do have Microsoft, Oracle, obviously a cloud player as well. But when it comes to running the internet, huge swaths of it rely on Amazon and their particular East Coast data center cluster where this issue occurred. And it's worth pointing out, back in 2023, there was a similar issue at the same data center cluster. And so we had seen issues then. We saw CloudStrike with Microsoft where there was that errant update from CloudStrike and it just went out and boom, knocked people off the internet. People's flights were canceled. So, it really is interesting to see how this kind of all went down. It was good that they came back online within the day. I do think it's also important to note that a lot of companies don't just say, okay, well, we're just an Amazon company, right? Because they want these redundancies. So they'll use Amazon and Microsoft's Azure, or Microsoft's Azure and Google Cloud Platform, one or the other. And so that's been kind of a kind of mantra for a bunch of companies for so long, and probably why, if you did see those companies before that were impacted, you were still able to access them. I used the Wegmans app. It kept telling me about issues, but I was still able to look up stuff for meals and basically how to cook a recipe. Got to throw it out there. Wegmans gives you good recipes, but it is one of those things where a lot of companies do rely on multiple clouds just to stay online.
And maybe they will even more now after this. All right, Dan, thank you so much. We'll be right back. Now time for some of today's trending tickers. We are watching Apple, 3M, and Unilever. First up is Apple. Goldman Sachs and Wells Fargo both lifting their price targets as they expect Apple to deliver a fiscal fourth quarter earnings and revenue beat. The upgrades come after Apple closed at a new record high for the first time since December. New reports on iPhone 17 demand are helping to drive the stock. The iPhone maker now on track to reach a $4 trillion valuation. The question is when? The shares are trading a little bit lower in pre-market, so we'll continue to track them throughout the session and the next few sessions. We'll see how long it takes. Next up is 3M, raising its profit forecast for the second straight quarter. The manufacturer also posted earnings that topped analyst estimates. The improved outlook suggests CEO Bill Brown's turnaround plan remains on track despite tariffs and economic headwinds. Since taking over as CEO, Brown has pushed to reignite organic sales growth while shifting production and making price changes. And finally, Unilever. The company says it's been forced to delay the spinoff of its $17 billion ice cream division due to the U.S. government shutdown. Unilever says the SEC is unable to register the shares of the new company to trade on the New York Stock Exchange. The new business, called the Magnum Ice Cream Company, was due to list in Amsterdam on November 10th, with secondary listings in London and New York. Unilever didn't give a timeline for the delay, but did say it remains committed to implementing that demerger in 2025. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Earnings season in full swing. So far, companies are posting strong results. Both GM and Coca-Cola topping expectations this morning. Joining us for more is Michelle Schneider, MarketGauge.com Chief Strategist. Mish, thanks for being here.
Thanks so much for having me, Julie.
So we were getting earnings that are starting to come in. By and large, they're beating estimates. By and large, they always beat estimates. But sort of reading beyond the beat or not beat, thematically, what are we learning?
Well, what we're learning is that the optimism has been warranted, especially as the Mag 7 is still starting to report now, with Netflix being the first one and then Tesla. And that the 493 other stocks in the S&P are doing better than what people thought. So that's a good thing. And of course, we have reasons to believe that even if we see some kind of a correction, and there are signs of that, especially the premier stocks may continue to do well down the road. Anything AI, of course, has been hot. And yet, there's always going to be warnings. And I think as an investor, you have to be aware. What I like to say, if you're going to cross the street, you want to look both ways. And we have some pretty obvious signs to watch for, so we'll see.
And so if you're looking, what is the investor equivalent of looking both ways? Like, how do you then guard against some of those warnings?
Well, gold certainly has been one of those warnings.
Yeah. Although it's down a little bit today.
It is. It's down a lot today, actually, considering. But then again, it's another one of those things that got so hyped up. I mean, we've been bullish gold for a long, long time now. We're actually flat, watching for a correction. But that's been a reflection. I like to say, if you want to see your imperfections or the market's imperfections, look in the mirror. That was gold. We also have, expectations now of CPI, and nobody really knows because the government's been shut down, whether we're going to see higher inflation, lower inflation, and certainly we've seen nuanced inflation. And then you have to look at some of the inside sectors of the market. So that would be, first of all, the consumer. And even though the consumer has been robust relatively to what people's expectations might be, if we're looking at, from a technical perspective, broke down XRT, which is the one I like to look at because it's staples and discretionary, that broke down under the 50 and it has not cleared back over the 50-day moving average. So what does that mean? Right now, consumers in caution. And we have to take that seriously. And then finally, if you have to look at something like the regional banks, which people thought maybe is just one or two cockroaches floating around, but yet there may be some more concern. So you have to watch these things, and that's what I mean, looking across both ways before you cross the street.
So that's where you should be looking at warnings. Where should you be investing right now? What are some areas that you think are everybody knows about the Mag 7. What's maybe not as appreciated?
Well, one of the things we really like right now is anything to do with infrastructure. So if we're looking at energy infrastructure, I just read, as a matter of fact, that Kinder Morgan and Phillips 66 are looking at expanding pipelines. And so I think it might be time to look at some of these oil companies that have been beat up, and particularly if you can get involved with the infrastructure. So there is an ETF called Alerian, it's AMLP, and that has been also beat up, but that could really start to grow because everybody's gotten so bearish in oil, but yet we know it's a commodity. Supply demand can shift at any time. And so that's one area. Another area that we're looking at right now, believe it or not, is simply long bonds themselves because of the lower interest rates potentially coming, because of some of the recession fears with labor market, et cetera, some of the factors we just talked about, the consumer, the banks. Bonds are actually getting a really nice bid, so we're looking at TLTs.
Gotcha.
And if they're just about to have a major breakout over 92.
All right, we'll be watching that. Mish, got to leave it there.
Oh,
Thank you
goodness.
so much.
Okay, thank you.
Appreciate it. That does it for Morning Brief. Opening bid next on Yahoo Finance.